So this is November 2016, question 3. Shall do it in entirety. Now, explain 3 assumptions of the traditional theories of capital structure. The assumptions, be it traditional theory, be it net income approach, be it net operating income approach, or be it Modigliani and Miller, the assumptions cut across. So you can just highlight a few of them for your documentation. So assumptions of capital structure theories. Next time somebody can say limitations of capital structure theories, assumptions of capital structure theories, shortcomings, the drawbacks, anything negative is about assumptions. So one of the assumptions or one of the drawbacks or limitations is that it assumes that capital structure, it assumes that the firms is always profitable. You can start with that one. It assumes that the firm is always profitable and pay taxes annually. It assumes that the firm is always profitable and pay taxes annually. Number 2, it assumes that capital markets are efficient. Capital markets are efficient in that all necessary information is publicly available. All necessary information is publicly available. So it assumes that there is no information that is hidden in the market. There's no investor that has all necessary information is readily available. So I was just explaining that point by appreciating that under the capital structure theories, it basically assumes that there is no single investor that has monopoly of information about the market. All information about the market is available to any person. It's an assumption, it's never the case. And of course, anytime you talk about capital markets being efficient, there's always an alternative assumption that says that capital markets are perfect. So hizo ni mbili ambazo zinakata across. When it's efficient, then it's also perfect. So it assumes that capital markets are perfect, such that no transaction costs exist. Capital markets are perfect such that no transaction costs exist. So hizo ni zile sorry. Excuse me. Hizo ni zile kwa tunaziita free marks. Wanakupa some 6 marks to explain 3 assumptions of capital traditional theories. Next time they can talk about 3 assumptions of net income approach, Modigliani and Miller. So hizo assumptions ziko mingi. You can have a bonus one. It assumes that some firms operate in environment of taxes while others do not. It assumes that some firms operate in environment of taxes while others do not. So ina assume kuwa kuna kampuni zinalipa taxes na kuna zenye hazilipi. Let's go to part B. Let's go to part B, where we are told that Maju Limited is just about to commence operations as an international trading company. The firm will have a book value of assets of 320 million, and it expects to earn 16% return on these assets before interest and tax. So return before interest and tax, we need to appreciate that that is simply earnings before interest and tax. Return is profit, return is earnings. So therefore, wametuambia kuwa our earnings before interest and tax is going to be 16%. So return of 16% on these assets. So 16% of 320 million. So there we go. of 320. So that is 51.2 million. However, because of certain tax arrangements with foreign governments, the company will not pay any tax. Ukiona any swali linasema hakutakuwa na taxes, then you start thinking about two capital structure theories, either net income approach or net operating income approach, which is income approach, and under net operating income approach, which is identical to MM1. So when you talk about net operating income, we also talk about MM1 because inafanana in all aspects. So they will not pay any taxes. It is known that the capitalization rate for an all equity firm in this business is 12%. Capitalization rate is the cost of capital, WSEC. So WSEC for an all equity firm that is unlevered, wamesema ni 12%. Just still interpreting the question. The company can borrow debt finance at the rate of 7% per annum. The management is in the process of deciding how to raise the required 10 million debt finance. Assume that MM assumptions apply. Using MM model without taxes, determine the current value of the unlevered firm. Now, just to jog our brains, and maybe for Mercy who was not in the previous class, we appreciated that under MM1, which is the same as net operating income, the value of the levered firm, is the same as the value of unlevered firm, which equals to EBIT divided by WSEC. Value of unlevered firm is the same as the value of the levered firm, which is simply EBIT over WSEC. So here we start with number one. They want us to calculate the value, the current value of the unlevered firm. So value of unlevered firm will be equals to EBIT divided by WSEC. Do you have the EBIT? I can see 51.2 million. 51.2 million divided by, do you have the WSEC? 12%, right?
Yes.
So equals to 51.2 divided by 12%. So that gives us 426.67 million. 426.67 million. And that gives us the first 2 marks. As simple as that. Penye natunyorosha tunauliza. You know, these things we may not get another time to go through them. So we appreciate them right now. So number 2, they want us to get the current value of a levered firm if it uses 10 million of 7% debt. Kumbuka tuko kwa MM1, and there's like a confusion that we was witnessed during marking of this sitting. I've just remembered. Many students got confused with how the question number 2 was tested. They just wanted us to appreciate that the value of the levered firm now, when they introduce debt, what will be the value of that firm? So examiner wanted you to remind him that whether we have debt or we don't have, under MM1 or N or I, debt does not affect the value of the firm. So the value of the levered firm will be the same as the value of unlevered firm, which equals to 426.67 million. Taka tu andike hivyo na unapata marks zako. na unapata 2 marks because of this concept. Once you have the value of unlevered, then you don't need to start looking for the value of the levered because of the formula up there. Then finally, number 3 for that, they want us to get the WSCC of the levered farm at a debt level of 7%, shillings 10 million. Now, under NOI and MM1, we just remind ourselves again that debt does not affect the value, neither does it affect the WSCC of the farm. So examiner angeset hii swali in a different way. Alternatively angesema hivi.
Excuse me.
Yes.
Number 2 is 436 or 426?
426, sorry.
Okay.
426. Thank you for that. Now, number 3, I was saying that alternatively examiner angeset hiyo swali akasema, prove that capital structure theories are irrelevant under MM1. Ama confirm that capital structure, confirm that debt does not affect the WSCC of the firm. Ama confirm that even with debt, WSCC tabaki 12%. So they are asking us to get the WSCC of the levered firm. While you are answering this question, we already know the answer that we expect. We expect to get 12%. Because WSCC of the levered firm, let me put it here, WSCC of unlevered firm is the same as the WSCC of the levered firm. So in answering number 3, we just now is a matter of confirming that. So tunaanza na appreciate kwa WSCC of the levered firm equals to weight of equity times cost of equity plus weight of debt times cost of debt. Taxes do not exist, so don't do 1 minus t. So let's see the value of equity. Value of equity equals to how much? Or go one at a time. So value of equity from our formula here, we know that the value of equity equals to, or let me put it this way, the value of the levered firm under normal circumstances is always a combination of equity plus debt. So that cuts across. So this value that we got is 426.67 has a combination of equity and debt. So out of 426.67, we have debt of 10 million. So the difference will be equity. So therefore, 426.67 equals to value of equity, which you don't know, plus value of debt, wamesema debt itakuwa 10 million. So therefore, we can get the value of equity, which would be equals to 426.67 minus 10. So that is 416.67. Why do we need the values of debt and equity? They'll help us get the weights, weight of equity, weight of debt. Hi. Then we come look at the cost of equity of the levered firm, cost of equity of the levered firm. Under normal circumstances, the cost of equity is profit after tax divided by value of equity. Normally, we are never given the PAT, but we are given EBIT. You're never given the PAT, but you're given EBIT. But I know very well, just allow me to put it here a little bit so that we can know the context. If I have EBIT, I'm supposed to less interest, right?
Yes.
and I have profit before tax. I less tax and I get profit after tax. This logic is what guides us in capital structure theories. Now, examiner will give us EBIT, like the way he has given us here, EBIT of 51.2. Out of this, if the firm has debt, there'll be some interest aspect. If the firm has tax, there'll be some tax aspect. In our case, M1 taxes do not exist. So to reach the PAT, we shall take EBIT with less interest. EBIT with less interest. And everything we divide by the value of equity of the levered firm. So that helps us to get, so EBIT minus interest is actually our PAT. Taxes do not exist. So can we have that? Our EBIT 51.2 minus interest rate, walisema ni 7%, shillings 10 million. So 7% of 10 million. And everything we divide by the value of equity. Value of equity was 416.67. So what is that cost of equity? So equals to 51.2 minus 7% of 10, that is 0.7, I guess. Okay, 0.7 times 10, and everything we divide by 416.67. So that is 10. That's 10 point something, 10.61%. Yeah, thank you. So that is 10.61, and that is cost of equity by the not WSEC. Do you have the KD? The debt is selling at par, so KD inabaki 7%. So therefore, our WSEC of the levered firm becomes weight of equity, which is 416.67, divided by 426.67 times the cost of equity ambayo ni 10.61 plus weight of debt, value of debt is 10 divided by the total of 426.67 times KD ambayo ni 7. Have we gotten it right?
I'm getting 10.51.
10.51.
Yes.
10.51, 10.52. lazima kuna
10.53. I
mahali
mean,
10.53,
10.53.
the same as what I have. I just need to check something because I expect my answer to be 12%. Where could we have gotten it wrong? With M1 or N or I, ukipata unajuanga tu umepata. Ukinyoroshwa vile tumenyoroshwa, tunajua tu tumenyoroshwa. So EBIT is 51.2 minus. Just a minute, I check. That's the beauty of understanding the concept. Ukinyoroshwa unajua tumenyoroshwa. So 51.2 minus 0.07 times 10 divided by 416.67. So it's 12.12. So here, so this should be 12.12, not 10.61. 12.12. Sorry for that. So this 12.12. So your answer is coming back to 12%. So capital structure theories. So debt does not affect the value or WSEC of the firm under an MAI. So as we answer that MM1, indirectly we are also revising net operating income. So 12%. So that is our 3 marks. Can we go to part C so that we can do another question on MM2? Why it doesn't make sense, please feel free to ask. Now, part C, assuming that the company in B above now pays taxes at the rate of 30%, compute the following in MM world. Now, when we pay tax at the rate of 30%, now that takes us to MM2. Now that is MM2. With corporation taxes. So amesema assuming that the company in B above now pay taxes at the rate of 30%, compute the following in MM world. So ya kwanza, the current value of the firm if it uses no debt. Now under MM2, the value of unlevered firm equals to value of equity of unlevered. And I repeat, profit after tax divided by the cost of equity of unlevered. Formula ni ile ile tu. Just playing around with these. If I want the cost of equity of unlevered, so it's part of a, now here I want the value, which is the profit after tax over the cost of equity of the unlevered firm. Or we can also say number of shares. It's good to remind ourselves, number of shares times the market price per share, if you've been given that information. But I know again, to get the profit after tax, I'll take EBIT. I'm supposed to less interest. And now, because taxes exist, I'm supposed to adjust for tax. In our case, the firm is unlevered, kwa hivyo interest hakuna. Let me rub this, because the firm is unlevered. The firm is unlevered, so there is no interest. So EBIT into 1 minus T divided by the cost of equity of unlevered firm. So do we have the EBIT? EBIT tulikuwa nayo 51.2.
51.2.
And do you have the tax? Wamesema ni 30%. So 1 minus 0.3. That will be 0.7. Do you have the cost of equity of the unlevered farm?
12%.
12%. So divide by 0.12. So equals to 51.2 times 0.7 so times 0.7 divide by 0.12. Is it 298.67?
Yes.
To 98.67. Na hiyo ni million again. And that gives us the 2 marks. Number 2, the current value of the farm if it uses debt of 10 million. So under MM2, value of the levered farm was equals to value of unlevered plus the value of debt times tax rate. It's called tax shield on total debt. It's not after tax, it's the tax on debt. So value of debt times tax rate. So that's hapa tumeenda kwa MM2. The unlevered farm is valued at 298.67 plus wamesema debt ni ya 10 million na tax ilikuwa 30%. So it's tax on debt, not 1 minus. So having 301.67.
Yes.
And that gives us the 2 marks. Then finally, the weighted average cost of capital at 7% debt of shillings 10 million. So number 3, WSCC of the levered farm equals to weight of equity times cost of equity plus weight of debt times cost of debt. But now here we must adjust for tax because now taxes exist. So we have debt and we have equity. And I know that just like we did hapo juu, the value of the levered farm, yes, it has its formula, but by all means has a concept of equity and debt. So that value of 301.67 has a component of debt and equity. So 301.67 equals to value of equity that we don't know plus value of debt ambayo wamesema ni 10 million. So can we have the value of equity? 301.67 minus 10. 301, not 310. So 301.67 minus 10, that gives us 291.67.
Yes, 291.67.
291.67. So that is the value of equity. So why do we need value of equity and value of debt? Number one, they'll help us to get the weights.
Well, not the weight.
They'll help us get the weight. And also in MM2, they'll also help us get the cost of equity of the levered farm. You remember that Kafani formula? So cost, na hii ndio kunakuanga, hii ndio inakuanga na kazi. Cost of equity of the levered farm under MM2 equals to cost of equity of unlevered plus the risk premium. Plus the risk premium. And how do we get the risk premium? So let me just combine them together. Cost of equity of the levered firm equals to cost of equity of unlevered. So for MM2, everything originates from unlevered. So we have to just, we start from the unlevered and we now bring in the concept of debt. So plus our risk premium is cost of equity of unlevered minus cost of debt times debt to equity ratio adjusted for tax. Hivyo tu Ku minus KD times debt over equity into 1 minus T. For consistency, wacha to summarize. Do you have the Ku? I think it was 12%.
12%.
Because we know that Ku is the same as the WSEC. Ku of the unlevered is equals to WSEC of unlevered, which equals to 12%. Do we have KD? I told
Yes.
7%.
7%.
Do you have the value of equity? 291.67. Do you have the value of debt? 10. And the tax rate is 30. So therefore we have 12 minus, sorry, 12 plus 12 minus debt is 7. Natumia tu vile iko so that the final answer will be a percentage. Hakuna haja kufanya 0.12 na 0.07. Ni kujitesa bure. So K, which is 12 plus K minus KD, the value of debt is 10. The value of equity is 291.67. And this one we adjust for tax. Can I do times 0.7?
Yes.
Times 0.7. Let's see if it will pick. You have 12.12 coincidentally. You can confirm. Mistake number 1. E 0.7 is not affecting this 12. So unamalizana na hii ya mbele huku kwanza. 12 minus 7, that is 5. So 5 times 10 over 291.67 times 0.7. The answer that you get, you add to 12. Hiyo ni mistake mbona wanafunzi wengi wakifanya. Wanaekanga yote and adjust for tax. It's only the risk premium that is affected by tax. We confirm 12.12?
Minute.
Okay.
Yes, 12.12.
12.12, thank you.
Yes.
So therefore, our WSEC of the levered firm would be equals to weight of equity 291.67 divided by the total of 301.67 times KE of 12.12 plus The weight of debt, value of debt is 10 divided by 301.67 times our KD is 7 and we adjust for tax.
That is 0.07.
Which one?
Cost of debt.
Yeah, nimeweka 7 badala ya 0.0, otherwise pia niweke 0.12.
So 7%, which is supposed to be 0.07.
It's okay. This 7% and this 12.12%. So
Okay.
I'm avoiding using the decimals because I
Okay.
know my final answer will be a percentage. So 11.88, and I know that is a percent. Is that?
Yes, 11.88.
Nice. So 11.88, what does it mean? That under MM2, introducing debt will obviously affect the WSEC and will also affect the value of the farm. And look at it. In number 1, part 1 of C, without debt, the value of the farm was 298.67. When we introduce debt, the value of the farm is 301.67. So debt is increasing the value of the farm. So by bringing debt, we maximize the value of the farm. The value of the farm goes up. Without debt, WSEC was 12%. When we introduce debt, WSEC is 11.88%. So debt is good. In all this, we appreciate that debt is good. Why is debt good? It increases the value of the farm and it reduces the WSEC. So we can do a conclusion on that. We just say under MM2, capital structure theories are relevant since debt increases the value of the farm, increases the value of the farm, and reduces its WSEC. So you can be asked to advise on whether they should introduce debt, advise the management on whether it's good, it's recommended to introduce debt financing. Could simply say that, yeah, they should go ahead and introduce debt, because by having debt in the capital structure, our value is going up and our WSEC is going down. We always aim at maximizing the value and minimizing the costs. I think that was a good question to start with. There was another one good. Let's have May 2015. Alafu tufanye 2015, then we can go do a recent one.
May 20?
I'm just checking kidogo. Yeah, here you go. 2015, question 3B of November 2015, question 3. November 2015, question 3. So part A, November 2015, question 3. Part A, we are being asked to comment on the assertion that capital structure is strongly influenced by managerial behavior. So they want us to comment on the assertion that the behavior of the management will always influence the capital structure. It's true. So you can just comment by saying, managerial behavior influences the capital structure. Managerial behavior influences the capital structure. Such that the risk averse management would avoid debt. The risk averse management will avoid debt, while risk takers would consider debt financing in the capital structure. While risk takers would consider debt in the capital structure. So to get the 4 marks, they just wanted us to, the behavior of the management is always associated with their risk appetite. Are they risk takers? Are they risk averse? Or are they risk neutral? So when you just highlight something on the risk takers and the risk averse, what do the risk takers do? Risk takers have no issue with borrowing. Risk averse will always be very pessimistic, will try to avoid borrowing. So mambo ya madeni si hatutaki. Those are the risk averse. Risk takers, they appreciate debt. They don't care. As long as money is coming in and the business is doing well, we can be able to pay our debts. And that's why they always say that the higher the risk, the higher the return. So debt is cheaper than equity. Assumptions of capital structure theories. Now part B. The finance director of Nuki Limited wishes to estimate what impact the introduction of debt finance is likely to have on the company's overall cost of capital. The company is currently financed by equity only. So currently the firm is unlevered. Nuki Limited summarized capital structure, ordinary share capital, the par value is 2.5 shillings. Have 5 million. There you have the reserves. So you can see the capital structure is equity, ordinary shares and the reserves. The company's current share price is 4.2 and up to 4 million shillings, 4 million of fixed rate 5-year debt could be raised at an interest rate of 10% per annum. So they can raise up to 4 million using debt of 10%. Tax rate is 30%. So you see corporation tax, you think about MM2. Without even being told. Maswali zingine wakuambiangi, we mwenye interpret na ujijazie. Nuki Limited's current earnings before interest and tax are 2.5 million. That is our EBIT. These earnings are not expected to change significantly for the foreseeable future. The company is considering raising either 2 million in debt finance or 4 million in debt finance. In either case, the debt will be used to repurchase ordinary shares. It doesn't matter. Na hiyo kizungu mingi, using MM's model in a world with corporate tax, estimate the impact on Nuki Limited's WSEC of raising shillings 2 million in debt finance and 4 million in debt finance. So how does it affect the WSEC? When we bring in debt of 2 million and when we bring in debt of 4 million, what does it mean? It's a comparative thing. What is the WSEC currently? without any debt. We start from there. How does it affect the WSEC? So in answering that, first things first, find out what is the current WSEC. Then we also look for the WSEC with debt of 2 million, and we also look for the WSEC with debt of 4 million. So current WSEC, which is the WSEC of unlevered, so equals to WSEC of unlevered farm, which equals to EBIT. Taxes exist, so 1 minus T, divide by the value of equity of unlevered farm. Just playing around with those figures and those formulas. Do we have EBIT?
Yes.
Samani 2.5 million.
2.5.
2.5 million, thank you. Do we have the value of equity of the unlevered farm? This time round, tunaweza pata the number of shares and tuko na the market price per share. So number of ordinary shares times the market price per share. How many shares do we have?
5 million.
11 million divided by? Sorry, 5 million divided by?
2.5.
5 million ni uongo. 5 million is the value of shares, not the number of shares. So how many shares were issued at 2.5 each to get a total of 5 million? 5 million divided by 2.5. Times, what is the market price per share?
2.5. 4.2.
4.2. 4.2. 4.2. So 5 million divided by 2.5 to get the number of shares, and each share selling at 4.2 shillings. So the value of equity becomes 8.4 million. So can we have the WSEC? That is 2.5 EBIT into 1 minus 0.3. And we divide by the value of equity, which is 8.4. That is 20.83%. Sawa? I think that's fine, right? Hi.
Yes.
So that is what we currently have. Then we are being asked, how will introducing debt affect the WSEC? So the new WSEC, so you are now answering number one. Now answering number one. WSEC with shillings 2 million of debt. With shillings 2 million of debt. So in that case now, it becomes WSEC of the levered farm, which would be equals to weight of equity times cost of equity plus weight of debt times cost of debt. But we have to adjust for tax. So the value of the levered farm tuko kwa MM2 equals to value of unlevered plus the value of debt times tax rate. Value of unlevered plus the VD times tax rate. Value of unlevered, is it 8.4?
Yes, 8.4.
Plus debt is of 2 million. 2 million times 0.3 tax on debt. So you're having 9 million. $9 million. That is the value of the farm. And we just go back and appreciate kwa yes, this component of equity and debt. So the value of 9 million has a component of equity, which we don't know, and debt, which is 2 million. Can we have the value of equity? 9 minus
9
9
minus
2. 9 minus 2, which is 7 million. Right? So that will help
yes.
us get the weight of equity. It will help us get the weight of debt. We have the KD. KD walisema debt finance of what percent? The company is considering interest rate is 10%. 10%. So KD is 10%. Just for tax to adjust. So do you remember the formula of cost of equity of the levered farm? Equals cost of equity of unlevered plus the risk
Plus.
premium, cost of equity of unlevered minus cost of debt.
Cost of debt into bracket and then that of equity into 1 minus T.
1 minus T. Thank you. Na formula zimeanza kuingia. Kitaki tu uoga, kosa kuwa muoga zitaingia. So KU was how much? 20.83. Siko hapa juu. 20.83 plus 20.83 times debt is 2, equity is 7, and we multiply by 0.7. $24.996. Can confirm. Pana 20.83. KD tujeka hapa 20.83 minus KD was 10. So this 20.83 minus KD, which is 10. I think that's fine. 22.996. Kompyuta zenu zinakubali hiyo? Yeah, I think tumepata. You okay up to there?
Nilikuwa nimetoka kidogo, network imenirusha kidogo, nimerudi sahi.
Sawa sawa. Masi, tuko sawa ama Mungu mbele?
Yeah. Iko sawa.
Haya. So work of the levered farm, the weight of equity 7 divided by 9. Cost of equity 22.996 plus weight of debt 2 divided by 9 times cost of debt is 10. We adjust for tax, so 10 times 0.7.
It's 2 divided by 7.
7 is the value of equity. The total is 9. So it's the value of debt divided by the total of debt and equity. Total of debt and equity is 9. Iko sawa? Ama turudie? Good. We okay up to there, all of us?
Yes.
Good. So that gives us the WSEC of the levered farm with debt of 2 million. And you can see what our conclusion was. Without debt, the value is 8.4. When you introduce debt, is it that one really? Without debt, the value of the, let me see, number of shares. So without debt, the value is 8.4 million, yes. When we introduce debt, the value becomes 9 million. So debt increases the value of the farm. Without debt, WSEC is 20.83. When we introduce debt, the WSEC goes down to 19.44. So debt increases the value and reduces the WSEC. So that is it. That is just how it is with the M2. We can look at part 2 of that. It's just repeating the same thing. Penye kuna 2 million, tunaweka 4 million. I don't know if I can give you some 5 minutes ujaribu part 2, alafu to mark. Can you try it out for 5 minutes, then we can mark. Where there is 4, where we put 2, just put 4. Hiyo tunaweza jaribu dakika 5. Think it's making sense. So with the, so now we need to get the number 2, WSEC with shillings 4 million of debt. The same concept. Value of the levered farm will be equals to value of unlevered plus VD times tax rate, which equals to value of unlevered was 8.4 plus debt is 4 times 0.3. So 8.4 plus 4 times
0.3. 9.6.
9.6 million. So meaning value of equity equals to value of the levered farm minus value of debt, which equals to 9.6 minus 4.
5.6.
So equity gives us 5.6 million. So the cost of equity of the levered farm, which equals to cost of equity of the unlevered, plus the risk premium, cost of equity of unlevered minus cost of debt, debt over equity into 1 minus t. So our cost of equity was 20.83 plus 20.83 minus KD was 10 times debt. Debt is 4, equity is 5.6, then times 0.7. So that is 26.245. I think that's what you got. So therefore,
Yes.
WSEC of the levered farm equals to weight of equity 5.6 divided by the total, which is 9.6, times the cost of equity, which is 26.245, plus weight of debt, which is 4 divided by 9.6 times the cost of debt, which is 10, and we adjust for tax 0.7. So this one can copy it. Nieke hapa. So 18.22226, I think that's what you got. And that is it, as simple as that. Hii imeingia. So again, what does it mean? The same concept. Capital structure theories are relevant because debt reduces the WSEC and increases the value of the farm. And as you can see, as we bring in more debt, the value of the farm goes up, the WSEC goes down. So as you continue introducing debt, it still affects our WSEC and the value. So debt is good. And finally, for the last 4 marks, you're being asked to comment on the accuracy of the estimates produced in B1 and 2 above. So are these figures accurate? Are our WSEC accurate? What do you think? So the okay, let's make a comment. You just say the estimates are not accurate. The estimates are not accurate due to the assumptions associated with their computation. Due to the assumptions associated with their computation, such as number 1 or number A, that the farm is always profitable. That the farm is always profitable. So there's an assumption that there's no single year, there's no single time that a farm will make a loss. It's always profitable. Number 2, actually hapo kuna kwanga na points mbili kwa tunaziunganisha pamoja, you can separate them. Number 2, That the firm always pay dividends. That the firm always pay dividends. That the firm always pay dividends. And maybe we can give one more. That payout ratio is 100%. It assumes that dividend payout ratio is 100%. And there's another assumption that dividends and earnings do not grow. So G equals to 0. Great. So that is MM2. I'll identify some questions when you attempt them out. Let's take some few minutes and have a formula, talk about MM3 and MM4. So MM3 with corporate taxes and personal taxes. So MM3 is with corporation taxes and personal taxes. Then you can say, MM argued that unlevered farm will be affected by personal taxes on equity, stock, equity ni sawa na stock, into brackets TS as well as the corporation tax, as well as the corporate taxes. That is T. Due to tax on dividends. Due to tax on dividends. So his stock, when you are all equity financed, there'll be an aspect of dividends that will always be there in that company, and those dividends attract some taxes. So the tax on stock will come in because of the dividends. The next you say the levered farm will be affected by tax on personal stock, that is TS, comma, corporate tax, and tax on personal debt. That is TD. So you can see the difference between levered and unlevered is the debt. So if I'm levered, there's no firm that can operate without equity. So whether I'm levered or I'm unlevered, equity will always be there. The difference between levered and unlevered is debt, not equity. Equity will always be there. So as long as there is equity, that means as long as I'm a company, I'll pay the corporation tax and I'll also pay the tax on stock. But when I introduce debt, on top of the two taxes, I'll also have to pay the tax on debt. So therefore, value of unlevered farm equals to value of equity of unlevered, which equals to profit after tax divided by cost of equity of unlevered. So how do you get the profit after tax? Unaanza na EBIT. EBIT. Debt does not exist, kwa hivyo hakuna interest, into 1 minus corporation tax. And because we have the tax on stock, we'll also multiply by 1 minus the tax on stock. And everything we divide by cost of equity of unlevered. As simple as that. So that is for the unlevered farm. And by the MM3 na MM4, hata hawataki calculate WSCC unlevered, wanataka too easy. From here, I know if I want to get the WSCC of the unlevered farm, I can get it. Because I know WSCC of unlevered farm equals to cost of equity of unlevered. From this formula, if I make K the subject of the equation, K inaenda huku, V ikuja huku. So EBIT 1 minus T, 1 minus TS, and everything I divide by value of equity of unlevered. So that is for the unlevered farm. You can put here you unlevered. Now, for the levered, the value of the levered farm equals to value of unlevered plus, I again use the same tax shield on total debt. Tax shield on total debt. Now getting the tax shield on total debt, on total debt. This time round inakuwa tofauti kidogo, equals to value of debt, plus 1 minus let me see if we can do this. Just a minute. So I'm just trying to make it it makes some sense. So 1 minus, so I have 1 minus the corporation tax, open the brackets, 1 minus tax on stock, and everything I divide by, your numerator I divide by 1 minus the tax on debt. I don't know if that makes some sense. So it's VD so this one is subtracting from this 1 minus the corporation tax, 1 minus the tax on stock, divide by 1 minus the tax on debt. So this is the tax shield on total debt. So meaning that to get the value of the levered farm, I'll take the value of unlevered plus this. So equals to value of unlevered plus this. So good. I don't know if that formula makes some sense.
Yes.
Yeah, this one sijaona kama imetestiwa. Itestiwa kitambo sana, I think somewhere in 2011. You have to trace back and try get that question so that we can you can look at it, or if I have, I'll check if I have a video for it, I can be able to share. But for MM3 and MM4, under the levered farm, they don't even want you to discuss about the WSCC, it's just the value. Just the value. So value of the levered farm equals to value of unlevered plus VD plus 1 minus. So 1 minus 1 minus the corporation tax rate. So the after tax zote. 1 minus corporation tax rate, 1 minus the tax on stock, 1 minus the divide by 1 minus the tax on debt. So these, all these, so 1 minus these. Then you add to VD. So this is the tax shield on total debt. Now, allow me to just take some maximum 5 minutes. Tutakuwa tumalizana na MM4. Maximum 5 minutes. Tafadhali tu. So MM4 with corporation, with corporate tax and financial distress costs. So with the MM4, I'll just go straight to the unlevered. So for the unlevered farm, this one, it is similar to MM2. It is similar to MM2. So you can refer to MM2. because MM4, the financial distress costs come in with debt. So for the unlevered farm is the same as the MM2. Value of the unlevered farm equals to value of equity of unlevered, which equals to EBIT. Kumbuka, it's with corporation taxes. So EBIT 1 minus T divided by the cost of equity of unlevered, or number of shares times the market price per share. WSEC will be the same, cost of equity of the unlevered. So WSEC of unlevered farm equals to cost of equity of unlevered farm, which is EBIT, into 1 minus T divided by value of equity of the unlevered, MM2 in a hold up. Then for the levered farm, hii inasema kuwa the value of the levered farm equals to value of unlevered plus value of debt times tax rate ni sawa na MM2. But now we subtract present value. Now they take this one, present value of expected future financial distress costs. Present value of expected future financial distress costs. Present value of expected future financial distress costs. That's the only difference. So these financial distress costs. Now to get the present value of expected future financial distress costs, we simply take our present value of future financial distress costs times probability. Hii tunakuanga tumepewa, hakuna kucalculate present value of future financial distress costs. This one examiner will always give you. Na atakupa probability. The only mistake that many students make hapa kwa probability, they don't use it as a percentage. NB probability must always be a decimal. Must always be a decimal, not a percentage. Not a percentage. So kama wameweka percentage, convert it into a decimal. So present value of future expected. So to get the expected, you get the future financial distress cost times the probability. Hivyo tu. Unless kama kuna swali.
Mesema last tested to this one of MM3 was 2011.
And I need to confirm, but ni kitambo. Haiko kwa
MM4, come on.
Yeah, MM4 imetestiwa. I'm just identifying the question so that we start with it on Thursday. There was an MM4 somewhere in 2021. 2021 decision 3. So 2021, this is just confirming which specific sitting of 2021. Yeah, here we go. So that is question 3B. Question 3B of May 2021, question 3B. May 2021, question 3B. So I'll deal with that. Then we have before we go to special topics in financing. May 2021, question 3B. So check on that one. Tutaishughulikia on Thursday for some few minutes, alafu tuende kwa special topics. Tutakuwa tumalizana na capital structure theories. Unless kama kuna swali.